So I'm here today with Brendan Llewellyn, consultant to the financial services sector. And Brendan has over 20 years experience in the sector in senior leadership and consulting roles, and has a very strong business ethic, which we'll hear about. Brendan also regularly writes for the trade papers, so who better to discuss with us the shape of the financial services industry and how it might look very different, some say more mindful, on the other side of the current situation. So today we'll be discussing the topic of more mindful financial services as we explore how the financial services industry needs to rethink and even reimagine itself to keep up with this growing tide of mindful businesses, and also for the potential of a new economic paradigm. So from your perspective, how is the financial sector looking right now?
Well, the advantages the sector has is that operationally it is easier for it to deal on a remote basis, perhaps than many other sectors. There are no physical products, for example. There are no shortages. There are no barriers to people dealing either through phone or email or through any online basis, and many do so already for a large part of their dealings. And as far as people at work is concerned, most of that still applies. I mean, there are clearly challenges in getting an entire company kitted out to work effectively remotely, and there are many serious security issues for many aspects of financial banking, for example, would have particular challenges in dealing with data where it's leaving the building. So I think overall, that bit is better than most other sectors, you might argue. The one area where there are real difficulties is a lot of the businesses in the finance sector pay themselves, shall we say, on a percentage of the assets involved. So if you're an investment company, your revenue comes in as a percentage of assets, and if assets have fallen, which they have over the past month or so, with a bounce, but nevertheless they are well down on the start of the year, then revenue has fallen, and it's a delicate, some would say commercially dangerous time to respond immediately to that with cuts. Those that have to will do, but those that can ride it through will be looking to come out of this. The other thing is that certain human needs are perhaps more heightened, various forms of protection, life insurance protection, health protection. There is an increased demand for that, business protection as well. Increased demand for that because of an increased consciousness of all our livelihoods. So I think it's a mixed bag. Our experience talking to financial advisors is that they are confident about dealing with existing clients remotely, shall we say, or online, less confident about starting new relationships with clients, a client perhaps who they haven't met, because that's always been a very, very person-to-person sector where a typical relationship might involve 3, 4 or more meetings face-to-face. Thereafter, of course, people would expect to deal through shall we say, more efficient digital channels, but the startup relationship has always been face-to-face for many. So a big question, it has to be a question mark, I don't think we can answer it, is can they convert in the short term? I guess the answer will be where there's a very clear need for a conversation, but perhaps something to do with a will or anything like that, then I think consumers will accept that a face-to-face isn't possible.
Yeah, it's interesting, isn't it, really, the way that you kind of describe that as almost being a bit of I guess, a sort of a mixed feast here, in terms of there are clearly going to be some winners and some people who are finding this as a bit of a challenge. And I guess that comes down to sort of individual personalities and the way that people actually have preferences for doing business, and that both is on the customer or the consumer side, as well as actually the provider side or the business side. In terms of the kind of the feeling and the sort of I guess you could call the sort of experience that financial advisors, but also the sort of the wider financial services sector is kind of feeling right now. I mean, when we look at the media, there's a lot of reporting going on about uncertainty, about big recession on the other side, the likes of which we've never seen. You know, a lot of the economists are talking about sort of 30%, you know, sort of drop in GDP, blah, blah, blah. There's this huge kind of swathe of sort of risk and arguably negativity coming through. Are you seeing that kind of sort of manifest in sort of actual people and the way they're actually feeling in terms of confidence within the sector?
Yes, in a word, yes, there is a widespread concern. No one in the sector, no one in any sector can be feeling particularly confident at the moment. This is an enormously difficult time to be going through, and people are not machines. So when they respond, you know, if you like, as business people, part of them, they have to respond as humans as well. So they may have people that they know that are affected by the virus, or they may have somebody in the family, or they may themselves have suffered symptoms, all of these things. So increasingly everybody knows somebody who's either you know, had very bad symptoms or slight symptoms or whatever, or even worse. So that's sort of creeping in to the business world. And then the projections for the economy are not you know, are concerning. People are talking about what the shape will be, and there's a lot of optimistic talk about it. It will be V-shaped, which others might say it will be W-shaped. These things are what the sector does. It talks in these sort of fairly jargonistic terms about, you know, future prospects. But the underlying point is that the economy will shrink this year. That's not in any doubt. And whilst there is separation between the fortunes of the stock market and the fortunes of the economy, there has to be some correlation at some point, so that there has to be concern about the what will the size of the financial sector be in, say, a year's time. And if anybody was guessing, they would say it will be down. And then the next question is, that's not much of a guess. A certainty, sorry, is it will be down. The guess is down by how much and for how long.
Yeah, I mean, certainly when somebody looks in as from a consumer perspective, you know, so they have a set of, you know, assets that they're looking to invest. They may well be looking to review their pension situation. There's a whole host of, obviously, you know, sort of personal or consumer related services that they might be looking to engage with. When they look into the industry, and I guess this is becoming much more of a spotlight as a sector right now, because with lots of industries, they've just gone very, very quiet. So retail, entertainment, for example, travel obviously has had its big sort of, you know, moment in the spotlight at the start of the crisis. But now I think sort of more people are starting to think about the real kind of more tangible aspects as to how it affects them. When they think about the financial services sector, I mean, a lot of the time, I guess historically, they've just thought about profit in terms of what is my financial return. Do you think that's actually fair as a reflection of kind of what the industry's been trying to do in recent years? I mean, we've looked at and heard a lot about kind of sort of ethical investment in pensions and wealth management, and that's certainly been something that's been growing. Do you think it's fair to kind of almost put a badge on the whole sector and say, look, you're just all about money, so actually that's quite an ugly thing that we shouldn't be talking about right now? Or is there kind of a better way on the other side that maybe the industry can start to begin reinventing itself so that it actually feels more kind of mindful, it feels more engaged with the current situation rather than just purely talking in monetary terms?
I think if we go back a few years, I think in terms of business culture, an attitude towards the consumer, the sector was somewhat caught on the hop, because for a number of years, and I'm thinking quite far back now, perhaps the 60s and 70s, the financial sector was somewhat behind the curve in terms of being, if like, a modern profit-orientated business. Much of the sector was still what you might call a mutual sector, owned by the policyholders, owned by the members rather than the shareholders. And some of these businesses operated as sort of enlarged societies or clubs, and actually had their members, if you like, constitutionally at heart. They nevertheless in terms of the way that they ran the business, they weren't necessarily as hard-nosed as perhaps their rivals were in consumer goods or in retail. So at the time when they started to get themselves up to speed as modern, quotes, aggressive businesses, that was the time during the 80s and 90s when things went a little bit wrong because perhaps they were being too aggressive. And it's very difficult to get, when you talk about cultural change, it's really hard to get the tone of the change right, because you look outside and you think, gosh, we don't seem to be as sharp as Gillette, no pun intended, but we don't seem to be as sharp as Apple or whatever. We need to invest in harder nosed business skills and not have an objective of keeping our staff until they retire, and change our mindset. And then at that same time, many of these other businesses in the wider world were actually starting to think that maybe there's more to business than profit. Maybe we should be looking at some sort of long-term customer affinity, some sort of customer proposition. And that will be the essence of how we run the business. So I think they were sort of caught in the middle, going in one direction when the world was going in a different direction. And most people are well aware of the various difficulties, called mis-selling difficulties. Most recently, the finance crash of 2008-9, which, the ripples of which are still being felt. Now, if you look now at most of the businesses in the finance sector, you wouldn't find much difference in terms of attitude towards profit, culture, etc., than you would in any other large businesses. There is like a coming together in terms of what is acceptable. The differences are in the execution, and when you're going through corporate change, and I think the finance sector has been going through pretty solid change in the right direction for the past 10, 15 years. But when you're going through change, there will be bits that don't quite work. As you'll have a mission or a vision or a purpose defined at the top, and it won't always be executed perfectly. And sometimes you might have somebody in between. You may have a CEO whose heart is in the right place and the board know what they're doing, but you've also got a sales director that might be remunerated on outcomes, bonus related pay, for example. And he or she will pass that culture down to the regional manager, down to the branch manager, and then the customers will feel that, and they will think, gosh, this company is a little bit sales orientated, and perhaps more so than other companies seem to be. So it's a fascinating time, but it is a time of not confusion, but of inconsistencies. And then, so the next question is about, is it about money? I mean, I guess if you're a consumer of any of these services, the question is, what is your own motivation? If you start a pension, what is your prime motivation in so doing? And without prejudging everybody's motivation, many people's objective will be to get the best possible outcome. They'll say, I'd like a larger rather than a medium-sized pension at the end of it, or I'd like a good return from my ISA, why would I not? And then, so most investment management, for example, over the past almost indefinitely, has been about maximizing return, taking account of risk, etc. And then we have the question of what other objectives you might have as a consumer, and therefore what other objectives you might have as a provider of financial services. And a proportion of consumers have become more interested in outcomes that relate to the environment, for example. The letters we use in this sector, ESG, environmental, social, and governance. So it's a balanced ticket. It's not just our environmental concern. It might be social. It might be concerned about diversity. It might be concerned about how you treat the staff. And on the governance side, there might be about controls. How is the business run? And what accountabilities are there throughout the business? Excuse me. So now, not every consumer has the same view, and not every institution has the same view. So again, this is a moving feast. However, the EC, as was, or as technically still is, has been doing some work to mandate, for example, pension fund trustees are involved now in having to take account of a wider range of factors than simply financial outcomes. And that tends to, what goes on in the institutional world sometimes tends to migrate to the retail world. So we fully expect people to be more alert to factors other than simple financial return. There has always been a notion that if you say to an investment manager, I'd like you to make money for me, but I'd like you to only invest in the following stocks, or I'd like you to avoid the following sectors like tobacco and armaments, then that will be a dampener on the return. At the moment, there's no evidence of that. And I wouldn't say there never will be, but at the moment, there's no evidence that an investment manager needs to compromise on outcomes for the sake of ticking other boxes other than financial return. In fact, there seems to be a harmony between wanting to do good from your investments and producing a good return. And one of the reasons for that is that a company that seeks to market to the public has to be better at all that than they perhaps had to be 20 years ago. It isn't enough for a company to say, we make widgets, please go away. The procurement division of a company that buys widgets will want to know what the standards are from that widget manufacturer. And the same sort of conversations apply to banks, building societies, investment companies, insurance companies. Some of the people doing the largest tenders want to know what that company will do in terms of adherence to whether it's United Nations standards or whichever standards.
So I'm interested in picking up on one of the points that you mentioned there, which was this kind of difference, I think, between kind of tangible brands and tangible products and services and this kind of intangible, often intangible nature of financial services. You used the two examples of Apple and Gillette. And obviously those are physically tangible products, which, you know, people can actually almost sort of trace through their whole kind of sort of supply chain, as it were. One of the interesting things I'd like to sort of touch on here and kind of explore is this whole idea of potentially greenwashing within financial services because of almost the, I suppose, the kind of covert nature of the kind of supply chain itself. So when you talk there about not investing in tobacco and almonds, obviously there's a whole plethora of other kind of sectors which are a little bit more sort of contentious in terms of whether they're appropriate to this kind of new world going forward. I mean, how does the industry begin to kind of avoid something like greenwashing when it kind of almost feels sort of morally obliged to be telling a good story?
I think it's a complicated question. I think that greenwashing isn't just about the supply chain, although the supply chain delivery chain is important. There is also the tendency of what I would call tick boxing. So if you are, running through a range of potential companies you might invest in, and it might be 1,000 companies, and you have to get down to whatever 50 or whatever. It may be that you reject certain companies on a very simplistic basis, rather than necessarily embrace those 50 companies on the most positive basis. So one aspect of greenwashing actually is about process where you get to the investment outcome you wished. Is it too simplistic? The other concern is that if you miss out on certain sorts of investment. We'll take an example of Amazon. So in some senses that ticks positive boxes, in some senses it doesn't. The positive boxes might be that it invests a lot in new technology. In some of their investments, will be no doubt of benefit to us all. There are other issues, the way in which it treats its staff, the mechanism of delivery is hard to say is helpful to the environment. Maybe partly a conspiracy between consumers and Amazon, if we all like the idea that something comes to our door without us leaving. The fact that the van driver has driven a mile, 2 miles, 5 miles, and only delivers a £10 item, perhaps we put that to the back of our minds. So maybe as consumers, we've got a responsibility to think about that. What are we ordering and what are the consequences of that? Because whatever you think about conventional supermarket delivery, at least it's in bulk. You know, you make one trip and you come back with £100 worth of 30 items. So there is some process efficiencies there. But back to the question of greenwashing, there will be some investment managers who have got no real interest in the environment or in social aspects or within reason in governance, who have to behave as if they do, because they're running a fund that's called the ESG fund or the environmental fund, and they've been opted into it. But that's been just a tad too cynical. The majority in that sector are extraordinarily committed, and within the financial sector at the moment, anything to do with aspects of diversity, whether it's principally gender, but other aspects of diversity, aspects of the environmental impact of behavior and investment, are massive areas of interest. The single biggest growth around some research just a couple of weeks ago, asking financial advisors what their current thoughts were on trends in the investment sector. The overwhelming figure was, I think, 85% voted for what might call sustainable investing or ESG as being the single biggest trend. If you ask a different question, which is how many of them automatically talk about it when they're talking to clients, it's still only 40%. So there's a big gap there. On the one hand, 85% think it's the biggest trend, only 40% are actually addressing it with their first client meeting, and that has to change. The third interesting stat is a much lower number of advisors say that only 9% of their clients consider it to be a paramount issue. That, I think, if we run the same survey in 6 months or a year's time, that will change. How quickly it'll change, I don't know, but this is what I mean by the idea it's complex. And when you're talking about an industry, people talk about we get the media we deserve. Do we also get the industry we deserve? So if the consumers are asking for a certain thing from their advisor, from the insurance company or bank or whatever, should they be surprised if that's what they get? So everybody has to move in the same direction for this whole big movement to work, a movement towards greater sustainability. The responsibility lies equally on the shoulders of individuals as it does on companies. If there's a gap between what consumers want and what companies want, there'll be a problem.
I think it's quite fascinating when you start to kind of delve a little more deeply into this kind of thing, because I think, for lots of people listening to this, they'll be thinking, okay, this is really interesting and it's obviously relevant to financial services, but actually I can see that it's kind of relevant to my business too and my industry. I think one of the things that you've picked up there is this whole kind of point of differentiation. If there are certain advisors who are kind of using this as a little bit of a lever, I guess, to that kind of proportion of their potential customers to whom it's actually relevant, and then there are others who are literally putting their head in the sand and saying it's nothing to do with me, it's not really relevant, customers don't want it, and also potentially even being in kind of denial. Even if they do want it, they're not even going to talk about it. It's really quite interesting thinking about this from a competitive perspective, and again this applies to all industries, because advisors typically will have very similar portfolios in terms of what they tangibly can offer. So how do you see them kind of using this kind of thought process to differentiate going forward? Because there's got to be a huge potential here for them.
Yeah, there are some financial advisors who already define themselves as being, we're all about sustainability, and they would market themselves in that way, and therefore attract clients in that way, and run their businesses in that way as well. They would have to. They're a minority, and that's way less than 10%, probably even less than 5%. So mindfulness or sustainability as a source of differentiation is in its infancy, shall we say. Differentiation for financial advisors hasn't been required. One of the reasons for that is that the supply of financial advice is quite low which means that very rarely does a financial advisor feel in daily or weekly or monthly competition with another financial advisor. 20 years ago, there were 250,000 people offering some form of financial advice, many of them working within the banks. That's changed massively due to regulation. And now there are less than, depends how you're measuring it, but less than 30,000 who would offer a broad-based financial advice service, a lot more who would provide mortgage advice only. But 30,000 plays 250,000, so to an extent they've been able to develop a business and choose the clients that they want to work with. There's a different problem, which is that unless you've got reasonable amounts of capital, you won't get a financial advisor to work with you. There will be no basis for them to be paid because they can be no longer paid on commission coming out of the product. They must be paid by a fee ultimately coming from the consumer. So the economics of being a financial advisor don't work really unless the client is probably slightly older than average and has got a little bit of capital to invest. 20 years ago, if you went along and took out a £50 a month savings plan with an advisor, the advisor would be well paid from that. That's no longer possible. So there's a odd set of dynamics. The other odd point, which has nothing to do with sustainability or mindfulness really, but I'll mention it, is that the people who really need financial advice are the ones who can't really get it. So anybody who's at the sort of bottom end of the income or capital, or perhaps has negative capital, they're not really able to get any I almost said face-to-face, then we can't say face-to-face anymore, but they're not able to get any individualistic bespoke advice. They're able to get generic comment or guidance from various sources like Citizens Advice, but the old equivalent of the man from the Prue knocking on the door to the industrial houses, houses in industrial areas, just doesn't exist anymore. So there is I come back in the circle to reiterate the point that means that advisors don't need to differentiate themselves strongly. They must be competent, they must have good people skills, they must have good technical skills, they must be qualified, otherwise they can't practice. And they must be there when their clients need them. And these are, if you like, generic qualities of a professional service rather than in themselves areas for differentiation. But the differentiation point, you mentioned branding early on, differentiation of all institutions in financial services hasn't been great either. If you deal with one of the major banks, I doubt that you'd be able to tell much about them that is different to my experience with whichever bank I use. We all want competent delivery of banking services. We don't want to lose our money. We want them to accurately tell us how much we've got and to carry out transactions and payments competently. And we don't really have other requirements from our bank. Now, when a bank has come along and said we're going to do things differently, and the best example is First Direct, it's great, but they're still a niche player. After how many years, decades in business, they remain a niche player. So it's more about, you could call it commodity service banking. Bankers would disagree, but that's what I would say. And when it comes to investments, there are huge numbers of people offering investment services. There's no issue there at all. It's hugely complex to decide which is the best investment house for your money, incredibly so, and that market is still 70% intermediated, so that you rely on an advisor to do the screening. If you did that as a consumer, well, good luck. It wouldn't be easy. You'd have to become a full-time hobbyist, and even then, I would doubt if it would be necessarily easy to do what you want to do. It's an area where the information is bleak. There is no information that tells us how well individuals do with their money. Frankly, there's not much information as to how financial advisors do with their money either. There's no league table of that sort. They would argue it's a bespoke service. So brand has been difficult. we can point to one or two large investment houses, but there are very few that I can think of, and I've been in the sector for 40 years, which have all the characteristics that a brand would normally have, i.e. the one where you feel an emotional attachment to, where you are drawn to them and you fully expect them to deliver exactly what it is that you want from them. And one of the reasons for that is that one of the key criteria for a brand is consistency of, usually if it's a tangible product, of look and feel. You expect it to look the way it's looked, and if it changes, you want to be sort of talked through that change. And if it's a brand that you consume or something you eat, whatever, you expect it to taste the same. It's back to the whole thing about branding when it was invented 150 years ago, even to deliver a consistent service or product. It is not possible to deliver literal consistency of investment outcomes. It will vary. The judgment will be made by an investment manager. The investment manager may do extremely well, but the stock market might drop by 40%. And as a consumer, you feel, well, that's all very well. He's done quite well, or she's done quite well compared to their peers, but I've still lost a lot of my money. Does that feel like a consistent brand experience? Well, not really.
So what's your big dream for the industry over the coming years?
I mentioned accessibility for advice. I'd like to see changes made which would mean that the people that need advice can get advice. This particular sector talks about the distinction between guidance and advice. In my mind, that's a non-distinction. The dictionary definition of guidance is the same as advice. Advice, technically, in this sector means something that, as a consumer, you could seek redress for if the outcomes go wrong. So that's why advice is important. And the answer to that is either advice in groups. So once we get unlocked, we can go back to groups, and the group might be in a workplace. We can receive advice there, and that can be cost efficient. And secondly, online. And as sophistication grows daily in what's possible online, and as consumers get used to deal with things online, many consumers who've never got the groceries online are now doing so because they feel they have to. Prior to lockdown, only 7% of the supermarket revenue was online, and now it will grow to be much more than that. That's a side point, but an important point. So people will get used to dealing more remotely. Conversations through, see the share price of Zoom has rocketed, for example. So I think that will be one positive outcome of like a tragic crisis, is that for sectors such as finance, where the economics require remote or digital communication, that will be easier perhaps in 6 months' time than it was 6 months ago. And that may make advice more readily available to a wider number of people. As far as the wider sector is concerned, as a lifetime marketeer, I would really like to see the differentiation that you talked about come in. And for it to be in 10 years' time, I would like to be able to have a chart with all the 10 major brands offering investment financial services, and for us to all know which of those brands is most suitable for us, just as we could if we saw a whiteboard with 10 car brands on it. We would instantly know, and most of us would instantly know which of those cars were right for us. We'd look at one that was called Rolls Royce and think, well, that's far too expensive. And we'd look at another one and think, well, that's, why do I need a Maserati? And we would know exactly what they would all deliver. The differentiation, financially or economically feasible levels of specialization, leading to a much clearer set of propositions, that will itself result in lower acquisition costs, because there will be a more ready, the role of sales as such will become less critical. At the moment it remains critical. And the role of marketing would rise, because the job becomes managing the brand, managing your reputation, managing the client experience, customer experience in a consistent manner to deliver something which in the wider world we call a brand.
and pulling all of that together, what a more mindful financial services sector we'd have. And I think one of the really nice ways that that could kind of manifest is this real kind of joining together of, as you've talked about earlier, consumer demand with the actual practicality of service delivery. If those two things can kind of join together, those kind of league tables allowing people to make really informed decisions, I think, you know, could certainly become, you know, common practice. So I think all of us, you know, on whichever side of the party we're sitting on, would certainly welcome that.
I think what we need to do is everything needs to be joined up. Nothing can work if it works through individual components of a system. We're talking here about an economic or a financial system. Individual parts of that system can't really work in isolation. So if a company is, for example, listed on the stock exchange, whoever is buying their shares, selling their shares, must be looking for certain sorts of behavior, must have a reasonably common set of metrics to assess what good looks like. Otherwise, a company would say, well, we're launching on the stock exchange and we're all about mindfulness, and we've got the following metrics that will assess how good we are at running our business in this way. And if the stock exchange says, well, that's all very well, but your dividends are appalling, or that's all very well, but you know, I can't see the financial return, it's not going to work. There has to be the way in which you run a business has to be a way in which A, your consumers value, and B, clearly your staff and other stakeholders, but taking the capital markets, you know, those responsible for injecting capital into your business have to be looking for the same thing that you think you're trying to do. And once you get that, it's like a new form of holistic, isn't it, really? It's holistic as in the entire thing hangs together. Is that a pipe dream? Well, the answer is that you know, it need not be, it may not be. There will still be companies who focus on the short term, but if consumers see the damage being caused by that, then they will start to vote with their feet. We need a stronger media, stronger press. That's a hugely difficult thing to ask for because you know, many journalists are, you know, there are less of them in certain key sectors, and many of them are not able to write and express perhaps as freely as they might, or have the time to research the subject as freely as they might to create the insights that we all need. Some of us looked at the development of the internet as being a driver for what you're talking about, Neil. And I'm sure to some extent it is, but if you look back at what's happening at the moment, the internet is creating new forms of distribution and media dominance. You know, you could see Mark Zuckerberg as a digital Beaverbrook or equivalent. You know, he in fact is, and if you look at Google, their control over the way in which we're fed information is unprecedented. There's never been anything as concentrated as Google. So the responsibilities that Google in particular have are absolutely enormous. And yet, obviously, at the moment, the accountability is low. So all of that, talk about everything, all the ducks need to be in a row, and not just being in a row, but swimming at the same speed in the right direction. Media and the new media, digital media, you could argue it's the most important part of that. It's certainly one important part. The capital markets, consumers, staff attitudes, the will of people running businesses, and the behavior of the wider digital world all have to be in harmony for us to make progress.
Brendan Llewellyn, thank you so much for sharing your time and fascinating wisdom with us today.
Thank you, Neil.